All right, welcome back to the Tim and Tim Show every Tuesday at 10 a.m. Eastern Time. I'm your host, Tim Vitale. Tim Vest is not here with us today because he is on site at a property, meeting with an insurance adjuster, trying to close out a property and a project that we've been working on for in 3 days. It'll be a year. So he's not joining me today, but he's also not upset that he's missing the year-end taxes K-1 and what your accounting and finance process should look like. Obviously, first things first, I am not a CPA. In my prior life, I was in accounting and finance function. Um, I never worked for a big four firm. I always did like corporate GL accounting and financial reporting and things like that. I was not a tax specialist. However, though I do know a lot more about taxes than most people, I'm very comfortable with it because of my financial background and my accounting degree and things like that. But I openly tell people just because you're an accountant doesn't mean you do taxes. There's a lot of other things that you can do in the tax and accounting world. So, all right, I have this conversation all the time with investors. When is my K-1 going to arrive? And partners too. I mean, I get a lot of partners that reach out, and they're like, "Hey, when are K-1s going to be done? Hey, Dennis, good morning. How are you?" Um, And this is my communication to everybody. And if you're a GP and this is your first tax year, welcome to the party, pal. The communication that we will have with our investors over the next week will be that we expect and are working our best in order to get our tax returns all completed by the corporate deadline, which is March 15th, 2026. So what that means is that all partnership 1065 return information has been submitted to your CPA so that they can generate your 1065 K-1s. What a lot of people don't know is that the first year that you do a deal, it takes the CPA significantly longer to set up your tax return info. Hopefully, you closed your deal, you sent them the investor list, you gave them the closing documentation, and they've had a jump start on setting up all of the individual K-1s. They have to go through each individual person to make sure that they're filing it for each member that's part of your operating agreement. And that just ultimately takes time. Some deals we have 50 to 100 plus investors, depending on how big the capital raise was. So it can vary wildly in terms of how many K-1s you have and how long it takes to create them. When you get into years 2, 3, 4, 5, and onwards, the tax return process becomes much simpler, much easier. There's not a lot of variables about there's not a lot of variables in terms of partnership changes. Yes, every year we do have to deal with people either changing their entity names or selling their partnership interests to a family member, or maybe there's a death in the partnership and having to work with estate attorneys and their CPAs to close out their estates and then transfer the equity into a new ownership. I mean, so those are some of the things that we've come across that obviously will bring some level of a delay to your K-1 filing process. But generally, once you're past your first year filing, it's just submitting your financials, your income statement. There's 4 Excel docs that we send: income statement, trial balance, balance sheet, and general ledger. The income statement, obviously, clearly is your income statement, profit and loss statement. Some people call it balance sheet, shows all of your assets, liabilities, equity, distributions, things of those nature. The trial balance is simply the chart of accounts, every single account in your entire financial book that shows all of the balances and the changes over prior year. And then lastly, you have your general ledger, which shows every single individual transaction that makes up those balances in the income statement and in your balance sheet. So the CPA takes those 4 pieces of information on an annual basis. Some things that could be changed over the course of the year is your cost segregation study. I generally tell people don't do your cost segregation study until the first week of January, because the cost segregation specialist, they can only do the cost seg study on invoices that have been paid. We do cash books, so we have to show the income, we have to show the expense in our income statement before they'll consider it as part of the cost segregation study. That's something that could cause delays in getting your K-1s back in a timely manner. But Tim and I, we haven't bought a deal. We didn't buy any deals in 2025, so we are just doing updates. We sold a couple properties, so those are getting wrapped up, and yeah, yeah, we don't have any cost segregations that we have to order this year, which is kind of nice. So um, today's January 20th. Geez, already 3 weeks into January, into the new year. I have successfully submitted one, two, three, four, five, six, seven, eight, nine, 10 entities out of 28 have been successfully reconciled and submitted to our CPA to have their K-1s updated for 2026, sorry, 2025 tax year. So I have a really, really, really good feeling this year that we're going to get at least 90% of our tax returns completed by the deadline this year. Last year we hired a controller, and his name's Mio. And the controller has really been helping out with a lot of the balance sheet reconciliations and staying on top of the bookkeeping to make sure that the books stay clean throughout the year. There's always some level of cleanup at the end of the year. I mean, I worked all this weekend and all last week doing the reconciliations of like our investor equity and investor distributions. Sometimes we have some reconciling errors between the report that we get from Syndication Pro versus what's reported in our ledger. So there's a bit of a process there to make sure that the reports reconcile. Ultimately what happens, this is like I think it's more of a syndication pro thing, but if you send out a payment and it fails, you have to reissue that payment. Well, the report doesn't withhold failed payments from your distributions report. So sometimes you'll find that your report is higher than what your cash was actually paid, and you have to go back through and do a reconciliation to identify which of those transactions were duplicated because they were reissued payments or they failed or whatever. So that can be quite a process when you're paying out distributions to a lot of different investors because there's just more variables of things to go wrong. One property we had capital contributions to as well as distributions. And that property took me about maybe 4 or 5 hours to reconcile the balance sheet on the equity and the distribution side, just because there was so much going on. And then there's also, there's issues with the syndication pro report. So I actually have a meeting right after this one to meet with syndication pro to go through some distribution issue calculations that I've found and see what the explanation is there so that we can do the reconciliation. So accounting is fun stuff. This is the life of a real estate syndicator, right? I mean, we use other people's money and we invest their money, but part of the deal is year-end tax returns. So it's a lot of work. I think it's a very thankless job. People will bark at you and yell at you pretty quickly if your K-1s are not completed in what they would consider a timely fashion. But there's so many variables between cost segregation studies, between other activities that happen within the partnership, between the CPA and their workload and their capability of being able to process all the K-1s and do all of the work. You can only control what you can control. So try to do the best in making sure that your books are clean and submitted in a timely fashion, because that will obviously make your chances of being more successful getting your taxes out on time. From an operator's point of view, one of the things that my dream company, right, Vive Equity as a dream company, would have an in-house CPA that does all of our tax returns. So they would, you know, they'd be responsible for doing the month end and quarter end reconciliations, as well as the year end and all distributions, and handle all of our investor stuff, which is mainly what I do. But I can't do the 1065 K-1s and actually submit them. But if you're, in-house and you only have to do our K-1s and you're in charge of the books all year long, when you get to year end, it should be a slam dunk home run, no issues with submitting, updating your 1065 and knowing that your books are clean and reconciled and that there's no issues, right? So that's my dream, one day having an in-house CPA and an in-house attorney to handle investor relations and tax returns and K-1s and all that type of stuff. But who knows? Maybe we get there, maybe we don't. But at this time, we're doing it third party, and yours truly is the one that is in direct communication with all of the CPAs to go through that. So, um, any questions first and foremost? I mean, I generally get a ton of questions when it comes to taxes and year end, and how can I help you understand, what to expect. I mean, it kind of went through the high level process of what needs to be completed in order to get your K-1s completed. I went through some of the common issues or problems that we come across that cause delays in K-1s. Um, I think one of the other biggest questions that I get, and I won't be able to answer this perfectly. When I asked my CPA to explain it to me in layman's terms, his response was, "Tim, that's why I go to continuing education classes every year because it's a very difficult thing to understand." So the contribution balance on the bottom left hand side of your K-1, the first year will show how much capital you contributed to the entity, and you'll have two percentages there. Generally, there's two percentages that show the percent of capital contributed and then percent of total equity in the deal. When you do a syndication on like a 70-30 split, for example, the investors contribute 100% of the capital and they get 70% of the equity. So their capital contribution percentage will be higher than their total deal equity. So that's a question I get a lot of the times. Um, and unless you're splitting a deal, you know, you know, just for easy math, 25, 25, 25, 25. Oop, am I breaking up a little bit here? Oop. Yeah, and I'll make it even easier. Tim and I, we do deals 50-50, right? Whenever we buy stuff, together as a group. In that instance, he and I will contribute equal amounts of capital and have equal amounts of equity in the deal, right? So in that situation, it would be 50% of the capital contributed as well as 50% of the equity. You could have JV setups where you have a couple of JV partners put up all the money, and then you have one partner who puts up none of the money and does all of the work, and they get a piece of equity in the deal. So you could have some percentage variations there as well. But that's generally how you will see those percentages and how to read those percentages on your K-1s. um, and yeah, so just underneath there, you'll have your capital contribution that should reconcile on your first year of how much money you put into the deal. So maybe it's 100,000. Year one, you might not get any distributions, but your capital balance will be reduced because you're realizing write-offs from your cost segregation study. So if you realize $100,000 write-off year one, you contributed $100,000 write-off year one, your net capital balance at the end of the year will show as zero. And it's not to say that your investment equity is gone. It's to say that you've realized depreciation that is equal to the amount of capital you've contributed. So that comes into play when you start doing, exits and 1031s and things like that, because that's how CPAs will track how much depreciation was taken and realized against the entity and what was your investment basis to write off against. That's my 10,000-foot view of how that little box works there. I would advise you to talk to your CPA on hypotheticals of what those numbers mean for you, how they can be applied, what you should be looking for. And ideally, you've had a conversation with your CPA, prior to year end or, after 2020, before 2025 ended. Hopefully you had a conversation with them. I personally do a meeting with my CPA usually the first week of December. And then that gives me enough time to kind of assess of, hey, I know what kind of money is going to hit the bank account by the end of the year. They know what my books look like because they do my bookkeeping throughout the rest of the year, so they can see what my income and expenses are. Thankfully, to date, I have not gotten the message of, "Hey, Tim, you got to go out and buy a truck this year so you don't pay any taxes." So thank goodness for real estate. All that depreciation, those paper losses of depreciation keep me from having to go out and buy depreciating assets for write-offs. So keep as much money as you can in your pocket. Hey, Joe, how are you? Good morning. Um, yeah, so we went through, what you should be doing, cleaning your books up, submitting your financials to the CPA. Generally, if you're a partner in a deal and you're not the one that's doing this, thank the person that is doing it because it is a mountain of work to be completed. And like I said earlier, it's a bit of a thankless job. People just think that the K-1s just bloop, pop, they show up like how W-2s are created and they're usually available like within the first or second week of of tax season because it is very much a formula pulled from payroll, right? It's very it's mathematical. I guess you could say everything is mathematical, but it's just basically how much was paid, how much was withheld, and they report that to you. When you're doing these 1065 K1s, you have so many different moving pieces in terms of capital contributions, distributions, cost segregations, income, losses, prior year depreciation, amortization. There's so much that goes into those tax returns, and the CPAs work really, really hard to get those done. Um, so a lot of times, K1s are not distributed on time, myself included. There are just sometimes deals take longer to return. We went through some of the scenarios last year. We had to deal with a death in the partnership, and that severely delayed the K1s being produced because we were working with the estate attorneys and things like that. Oh, how long do you have to hold a property after cost seg so you don't have to pay tax on it? Dennis, you are always going to have to pay tax on capital gains, right? Um, and your capital gains are going to be realized as what was your purchase price plus all of your capitalized capex expenses, right? So your total asset value versus your sale price, and the difference between those two numbers are your capital gains. When you do a cost segregation study on a property, you are realizing depreciation up front. And what happens is you have what's called a depreciation recapture. And on depreciation recapture, you are taxed. I don't know what the percentage is. I think it's like 25% of your depreciation, 25% of the depreciation that you've taken above and beyond your capital contribution balance is what you will be taxed on the depreciation recapture. Now, somebody could fact check me on that. That's my understanding of it. But generally, depreciation recapture is not fun, but you're still in a better position financially and in a tax position if you're being taxed on depreciation recapture instead of 100% of the capital gains. And the reason there is you're only paying 25% of taxes on the depreciation that was recaptured, right? Instead of whatever your normal tax bracket rate is, right? So, like, if you realized $100,000 capital gains loss and you're in a 40% tax bracket, you would have paid $25,000, or sorry, you would have paid $40,000 in capital gains taxes, right? If you're in ordinary income and that's how you're using your write-offs, right? Well, okay, so you realized a $40,000 tax payment that was not sent to the CPA in 2020. Now in 2025, you sell a property, you have to take your depreciation recapture of $100,000 because that's what you claimed and that's what you wrote off against your capital gains elsewhere to save your $40,000 tax payment. Well, now you're going to get taxed on, I think it's 20-25%. Well, then so you're getting taxed 25% on your 100 grand, and you owe the IRS back 25,000, but you're still net positive $15,000 because of the difference between what you would have been taxed on the capital gains that you wrote off against versus the depreciation recapture. So, yes, you are going to owe taxes on your depreciation recapture, but ideally if you did it correctly, you saved more money in ordinary income taxes or even long-term capital gains, or deferred it so that you can invest the money and multiply the money many times over from that point, but you will end up owing money back when the depreciation is recaptured. Does that make sense? Did I explain that clearly enough? Yeah, absolutely. Yeah, so you can definitely do a 1031, right? So I had a conversation with a CPA about a property that they suggested Tim and I should 1031 because our cost basis is so low that when we go to sell it, our capital gains are going to be in the multiple six figures, maybe even seven figures of taxes owed. Which is a great thing. But he was like, this is a prime opportunity for you to 1031 into something and then refinance it, pull some money out, and then just sit on it and own it. I have seen I have seen where investors have 1031 so many times that their tax liability owed is the same balance of what their cash balance is. Right. Yeah, the tax liability owed is the same amount as their investable balance, right? So what does that mean? Say this investor's got a 1031 for $1 million. there are scenarios where you could come across and say, because of the 1031s that are attached, maybe they 1031 seven times now, right? Because of all the 1031s that are attached and the depreciation that was never recaptured, they might owe $1 million or more in taxes owed back to the IRS if they don't 1031 the money. So then you're stuck. You will always have to do a 1031 at that point, because then if you don't do a 1031, you essentially lose 100% of your equity balance to back taxes that have been deferred by doing depreciation deferments from 1031s. I've seen that. So you could come into a scenario where your taxable liability is greater than your investment balance, right? So like you could owe $1.2 million in taxes, right, from depreciation recapture, and only have $1 million to invest. If you don't 1031, if you don't 1031 that money, you will then have to pay $200,000 to the IRS on top of, you lose 100% of the money that you had, and you owe $200,000 on top of that. Yeah, Daniel Reddick, you're right. You could 1031 into a opportunity zone. A lot of people do that. You could do a Delaware statutory trust, a DST. There's a lot of opportunities of things that you could 1031 into, and I'm not saying that you should. I'm definitely not saying that you should realize the 1031 tax. You should just realize the taxes, right? I don't think that's a good idea. But eventually, Peter comes to get paid, or Paul comes to get paid. Robbing Peter to pay Paul, right? So eventually, Peter comes to get paid, right? Because he's been robbed the whole time. But you could 1031 into an opportunity zone. For those of you that don't know about that, you would 1031 into an OZ, as they call it, and you'd have to hold the investment for a minimum of 10 years. But then at the end of that 10-year period, when you go to sell it, all depreciation and capital gains and all prior balances are forgiven, right? So that's a way that the government incentivizes people to invest into developing areas in large cities and even small cities too, is so that they know that there's a tax benefit to investing in an opportunity zone. And it's a way that the city will attract capital and new investment capital to a new area of the town to spur its growth. Is that, people are willing to 1031 into a opportunity zone and hold it for 10 years so that when they go to sell it in year 10, that their previous tax balances are wiped out. So yeah, that's an option too. Lot of fun stuff. I like talking about taxes, but Tim Vest's eyes kind of glazed over a little bit when I was like, I'm going to talk about taxes, I think. So he lucked out on not talking about taxes. But yeah, what other questions that you guys would want to talk about um, in regards to year-end taxes, K-1s, and what real estate investors should be doing right now if you haven't started already? I feel like most people know that you have to be doing these, submitting your financials to the CPA, but there's LPs out there that have no idea what that process looks like, when they should expect to get their K-1s. I can say the biggest thing on the communication side from my perspective is that I have not sent out investor updates yet, as the financials have been completed, because my primary focus is to get my financials into the hands of the CPA so that they can complete the K-1s on behalf of all the investors. So in lieu of getting your investor updates early, well, we're trying to get our taxes completed faster. So the investor updates will come out a week or two later than they normally do. But the caveat there is that, hey, we're trying to prioritize getting the K-1s completed for all of the entities across the board. Um, but yeah, we'll just tell people what the expectations are. I never commit to um, producing the K-1s before the timeline. I would just communicate what the effective timeline is. Obviously being March 15th is the required deadline to file them. If you didn't if you didn't complete your 1065 by March 15th, your CPA has to file an extension, and then your 1065 is due by September 15th. But if the K-1 is completed before March 15th, fantastic. Like that's amazing. But there's obviously what we started out talking about was there's a lot of factors outside of your control that impact that. So obviously you do your best in order to get them out on time, but there's no guarantees there. A lot of the time, a lot of our K-1s are usually done by the end of March and or the first week of April. So that way a lot of our investors are able to file their tax returns by April 15th so that they don't have to file an extension. But any of my investors, I always advise them like just file an extension no matter what. And if you file late, there's no penalty to do so. Um, and I don't want to be held liable for a CPA not being able to get the K-1s out on time. So it's always a good idea just to set the expectation of, hey, we're shooting for March 15th. We're going to make our best effort to get them done by March 15th. If not, they might be a little bit after that, but before April 15th filing deadline for you. But if we know that we're not going to meet our deadline by April 15th for you to file, we will send out like a separate communication to investors to let them know, like, hey, you should plan on filing an extension with your CPA because we know that our CPA is not going to get these done on time. Dennis said, "How much of a difference is tax wise doing LIHTC than regular multifamily?" That literally zero. Well, sorry. Let me think about that for a second. I think on the development side, I've never done the development side where you get all the tax credits and all that kind of stuff. I believe all the documentation is communicated and filed and part of the closing process and being granted the tax credits by the government. There's probably paperwork that you would just submit to the CPA and they would do adjustments on your 1065 filing. But past that, in terms of like LIHTC regulation, that's all compliance related and associated with the governing agencies that handle that, right? So, like for us, it'd be North and South Carolina housing authorities. They would govern to make sure that your LIHTC is in compliance. And at the end of the year, you have to do certified audited, like third party audited CPA financials. And then those financials are submitted to the agency for your approval to say that, hey, you're in compliance and that there's no penalties for you for your tax return. All of the deals that Tim and I do are not in the initial compliance period. They're all in the extended use. And there's no tax implication for LIHTC deals that are not in the initial compliance period, only the initial compliance period. But in terms of everything else, the LIHTC in the extended use is just a compliance piece of making sure that you are renting to households that qualify to live there. If you are found to be out of compliance, it's kind of like a black mark on your record, and they could withhold housing payments from you. But they usually are generally are willing to work with you to help you get it back into compliance. But it should make no, it really doesn't make any impact on your tax filing at the end of the year. I mean, because ultimately it's still income and expenses in terms of, for the CPA, right? The LIHTC compliance is another agency that's not a CPA. Like they're not tax accountants. They're there to make sure that you're renting it to the qualified individuals that, and you're adhering to the covenants that are attached to your title, your LIHTC LURA land use restrictive agreements. And then, the CPA just says, hey, what was your income? What was your expenses? What are your write offs? What does your cost segregation look like? And boom, here you go. Here's what you have to report to the IRS as what your net income or losses are. So it's kind of two different buckets there, really. Good question, though. I hadn't thought about it, but yeah, there's definitely got to be some level of tax compliance in the initial compliance period because you do have to get audited financials by a third party CPA and then submit those to your CPA to do the 1065. Unless unless the same CPA firm can do your 1065 with with those audited financials. I'm not entirely sure how that works. So, but good question. Cool, just didn't know you get any breaks. No, no, no. The tax why is this so blurry? The tax breaks are realized on the development side, right? So the tax breaks are realized on the development side, and those tax credits are generally given to the developer, and and the developer will go and sell the tax credits, and it's called a syndication. They syndicate the tax credits to high net worth individuals and businesses that need like actual write-offs and they will sell those tax credits for equity for cash. And then they'll take that cash and go use the cash as the down payment on the loan to go develop the property. So that all the tax stuff happens on the front side, not on the back end. So All right, guys. Well, thanks. Appreciate everyone joining this week, and hope you learned something. Hope you found this interesting. I know I do, and I talk about taxes and tax returns and stuff like that with investors all the time. So appreciate everyone joining and asking questions, and we'll see you next week. Peace.